Good afternoon, welcome to Markets Today afternoon version. It's me, George Bodo, co-hosting this afternoon session with Mbithe Mwema. We have a lot of discussion ahead. We're discussing Kenya's low savings growth rate. And we'll also be looking at comparison with that. Reginald Kazutu, who is of Amana Capital and a very when it comes to saving issues. He wrote an article about a day or 2 days ago about how to rejig savings in Kenya. We're going to be discussing some of the issues in that space. We're also tracking the market just about 30 minutes to market close. We'll be looking at some of the pre-market close figures. And we'll also be talking about the FX market updates. As at now, just about 30 minutes ago, we understand that actually the Kenyan shilling continued to claw back some losses again in the USD. You're talking about 102.6, 102.4 thereabout. Some positive news there. We also understand that the central bank is actively withdrawing liquidity using term auction deposits securities up to a tenure of 28 days at a rate of 5%, which is very low. But the reason we understand is because the market is very, very liquid. We are talking market updates. So far, the Nairobi Securities Exchange happenings. Big trade on Britam, about 13.5 million shares traded, and Britam today dislodges Safaricom as a top trader. 13.5 million shares traded on Britam, but the price is actually down 7.5%.
Wow, that's
Do you read anything into this?
I'm not too sure. We'll probably have to chit-chat with the brokers once the market closes. But I do recall that the last big trade that happened on Britam, it was a foreigner selling to a local. Yeah. But then the price had not been affected then. So I'm curious to see.
Exiting. It's a big block of trade.
But 7% down means it's probably it was off market and they came to execute today. Because that doesn't look like just a day trade. It's probably something that has been happening for a while by the time you see such volumes on Britam.
Yeah, we probably will speak to market participants.
Certainly. By the close of the market, we'll have a better...
Another surprise inclusion, the top rate is Barclays to 10 million shares.
Okay, that's also a huge trade.
The price actually still down. That's a big trade for Barclays.
All right. What was the price?
Yeah, I think
differential?
the price is down about 3%. They're about not sure.
Okay.
But
so it's closer to the 10.
It's red. It's not.
Okay.
It doesn't contribute to a price going up.
Oh wow! So that makes it more attractive. It's dividend yield. It's been the highest dividend-paying stock. I mean, in terms of dividend yield.
I mean, it's always been.
It's been 9%. So if it goes lower 3%, then something worth looking at.
Something worth looking at.
Yeah.
Some bargain trading.
Some bargain, hoping that their cost for restructure does not reduce the dividend payout in this financial year. Yeah. Because if that has an impact, and they keep saying in their meetings that they're going to take a haircut in terms of how much they're going to aggressively spend to just reorganize themselves and restructure themselves vis-a-vis the new brand APSA. So then the question is, are they going to reduce the dividend? The warm red brand. Does the warm red brand mean a downward trend, a downward red arrow for shareholders with regards to dividend payout?
We'll wait and see that. Okay. But of course, you know, APSA rebranding to APSA is actually a big cost on Barclays.
It's a huge cost.
About 200 million shillings Q1.
And they're going to, so you can you imagine if you have that run rate for the full year, it's closer to $1 billion. Yeah,
and you remember the full rebranding happens in June next year.
Ooh,
so you're looking about something north of $10 million. That's quite significant.
Unless they chance some double-digit earnings growth, then
but there's also some good news in the FX market.
Okay.
Central bank, we understand, is actively withdrawing liquidity from the market.
Okay.
You think that this shilling will continue to claw back some losses?
No, I think this was expected, and we've had an extensive conversation on this because it was really transitory and it was more of technicals, demand and supply. Yeah. And CBK does have the muscle to be able to manage that. Yeah. I think that the key to differentiate and to keep saying out there is fundamentally there is an overvaluation on the currency, but the CBK has the reserves to ignore the fundamental element, at least in the short term. But you could see a bit of trading weaknesses, but now at 102, I think 102.3.
Yeah, 102.4.
102.4. Yes. And then previously, I think yesterday it was at 103. Yesterday or 2 days ago, 103. So
Tuesday we were talking 103.1.
End month demand, so that's cyclical. End month demand is done. You just go back to.
It's a very cyclical phenomenon.
Exactly.
Are you a member of this overvaluation group? You think
yes, I am. Yes, I am. Yes, I am. I just need to get to the end point where I am able to factor in the technical element in terms of the FX reserves that CBK has, and not even that, the diaspora funds that it gets. Because if you compare the outflow, demand of currency vis-a-vis the monthly inflow of diaspora remittances, then CBK governor has almost 4 to 5 times cover of his monthly need, based purely out of diaspora funding. But then because that is so technical, then I'm always unable to find a way to just connect it to the fundamentals, because the fundamentals say the currency needs to be here. But then he's able to manage it each and every other day, thanks to the diaspora. Maybe we need to speak to the people in the diaspora.
Yeah, I think we need,
on a light note.
Yeah, I think so. I think one of the things, talking fundamentals, one of the things you're worried about in some of the statistics, Kenya National Bureau of Statistics released Kenya's Q1 balance of payment position. It shows generally that current account deficit as a share of GDP continue to narrow. We were talking about 3.2% as a key one. If you go back to 2014 when it was 10%, it's a big improvement. But the problem is that the narrowing of the current account deficit continues to mask one underlying important aspect, is that exports are also not growing. And will not grow. And in fact, Q1 exports will decline 3%. So in a situation where, well, imports have declined largely because of the decline in importation of SGR-related heavy machinery. There's the SGR, then you do remember, I think 2 years ago, the government increased taxes for actually importing, so it became much more expensive, clearance, just getting your things through from China to here. So then that reduced the demand from the smaller importers. But are you worried that in as much as imports are on a downward glide, exports are not catching up? I don't think they ever will. I don't know, because today we're discussing Big Four, and I have a lot of respect, the utmost respect for the policy makers in this country and the executive office as well as CBK. But then we're in a space where we keep referencing what has worked for other countries. So what does IMF say if you want to develop? What does the West say if you want to develop? What does the East say if you want to develop? But then we keep ignoring what do we need to do to develop. So we're always on a constant phase of we need development, the government needs to spend to spark growth. It's not sustainable, and we are funding it on debt. So if you ask me whether export will happen, we're exporting the wrong things. One of the discussions is about some of the two things. Is one of them is savings. Certainly. So we'll touch on that. We are discussing savings. Very exciting conversation. Very exciting. Another issue is that I hope you've been saving. I want to know, are you at closer to 100% or zero? Or is that personal, too much information? That's TMI. Fair enough. A bit of TMI there. But we're going to get that. But something else we're also watching is, yesterday I was watching news, and Strathmore University, in collaboration with, I think, a consultancy firm, CISPRO, they released a survey on the state of the manufacturing sector in Kenya. And manufacturers have actually cut down on capacity. Well, they are doing 3, 4, 5 hours a day. Electricity is so expensive. How do you grow exports if manufacturing has cut down on capacity and delaying capex? That's not good for the economy. It's very expensive. And even just to touch on that, because in a way we are getting into the Big Four agenda, affordable housing. If you think about it, the government will need to consume a sizable amount of cement. But then what happens is we end up importing the clinker and extending it to create cement. So the value proposition for you as a local manufacturer is just turning the clinker to cement and having the right networks globally to get the cheapest clinker. So how are you developing manufacturing if you're not manufacturing anything here? Jobs. Exactly. Yes. We're going to take a short break. When we come back, we're talking savings rate, we're talking wage growth, you're talking inflation. Let's look at why savings rate in Kenya is very low. We look forward to that discussion. See you shortly.